Right now, the world is watching the Iran war unfold, but traders are watching something else: the markets. Oil prices are surging, global shipping routes are being disrupted, and major stock markets are already reacting to the uncertainty. But here's the real question most people aren't asking. What does this war actually mean for your trading account? Because when conflicts threaten critical energy routes like the Strait of Hormuz, which carries about 20% of the world's oil supply, markets don't just move, they can violently reprice risks. And that's where traders make their biggest mistakes. Fear, headlines, and emotional reactions start driving decisions instead of strategy. So in this video, I'm going to break down exactly how the Iran war could impact the stock market, volatility, and your trading psychology. And more importantly, how disciplined traders prepare for moments like this. So stay with me, because what happens next in the markets might surprise you. One of the most direct market impacts on the conflict is global oil prices. You see, Iran sits at a strategic choke point, and hostilities, especially disruptions around the Strait of Hormuz, through which roughly 20 to 30% of global oil flows, can sharply reduce supply expectations. This has already sent crude prices sharply higher, with big jumps in both Brent and WTI futures as traders price in supply risk. Rising oil is not just about energy stocks. It feeds through inflation expectations, sector leadership rotation, and risk sentiment. Traders who ignore commodity shocks are blind to a core driver of equity and macro movement. But oil doesn't just move energy stocks. It moves the cost of everything, and once energy rises, inflation quietly enters the conversation. As oil prices rise, production and transport costs rise too, which eventually shows up in consumer prices. Higher energy costs can slow economic growth, pressure profit margins, and prompt shifts in Fed policy expectations. That means inflation metrics, CPI, PPI, and inflation expectations suddenly become more sensitive to geopolitical headlines. Bonds and risky assets alike react quickly when the inflation narrative shifts as well. And when inflation uncertainty increases, capital doesn't disappear, it seeks protection. In fact, in times of elevated geopolitical risk, capital often flows out of risk assets and into traditional safe havens like U.S. Treasuries and gold. Investors perceive these as stability anchors, even if growth prospects dim. Sections of the market that typically rally during uncertainty may continue to outperform. This rotation isn't random emotion, it's structural repricing of risk. For active traders, that means adjusting exposure rather than assuming the market's mood will stay the same. But as money rotates into safety, volatility expands in everything left behind because conflict and uncertainty increase short-term volatility. Major U.S. indexes and global equities have weakened as traders absorb war implications. Even when fundamentals are unchanged, risk aversion increases, causing wider daily ranges and bigger swings. And that volatility isn't random noise, it's a signal. Once volatility rises, stop losses, margin calls, and algorithmic responses add fuel to the moves. Smart traders plan for these shifts instead of reacting to them. And once volatility spreads, it doesn't hit every sector equally. It reshuffles leadership. War changes sector leadership because energy and defense sectors typically strengthen, while transportation, travel, and consumer discretionary sectors underperform. Defense equities, in particular, have recently rallied as expectations for sustained military spending grows. This dynamic teaches a key trading psychology lessons. Environments change, and what worked last quarter may be obsolete next quarter. Traders must anticipate flow, not cling to stale thesis. Yet sector rotation inside the U.S. is only part of the story. Global markets feel the shockwaves too. Already, Gulf stock markets have temporarily halted trading due to heightened instability. These halts reflect investor caution and can disrupt global trading flows and sentiment. When a major regional market stops trading, global liquidity patterns shift and correlations adjust, which affects everything from FX to emerging market ETFs. And when global uncertainty rises, the most powerful force in the market isn't oil, inflation, or bonds. It's human emotion. War headlines trigger fear and uncertainty in human brains. This leads to risk aversion, overreactions, and crowd-driven behaviors that can exaggerate moves beyond fundamentals. Traders who read fear instead of facts get trapped. Those who manage emotion over narrative maintain discipline, structure, and strategic edge. Which means the ultimate edge during geopolitical conflict isn't predicting headlines, it's mastering your response to them. The world doesn't trade in a vacuum. It trades in fear and expectation. When conflict escalates, like the recent strikes involving Iran, markets don't just price fundamentals, they price uncertainty itself. Oil prices have already surged sharply. That shift doesn't just impact energy sectors, it triggers collective nervous system response. Traders begin to ask, what if this gets worse? What if inflation spikes? What if growth slows? This morphs markets from rational calculators into emotional-driven ecosystems where fear and anticipation coexist with price. Fundamentally, human psychology, fear of the unknown becomes as impactful as geopolitical events themselves. This morphs markets from rational calculators into emotion-driven ecosystems where fear and anticipation coexist with price. Fundamentally, human psychology, fear of the unknown becomes as impactful as geopolitical events themselves. Volatility isn't the enemy, emotional reactivity is. Geopolitical shocks, by definition, raise uncertainty and therefore volatility. As markets reassess growth expectations and risk-averse players rotate into safe havens like gold or bonds, while others de-risk equities in tightened positions. These moves aren't just patterns, they are the collective emotional output of millions of decisions influenced by anxiety, projection, and survival instinct. Traders who are unprepared psychologically tend to misinterpret this volatility as threat rather than information, treating swings as personal danger rather than market mechanics. That's where psychology matters most. If volatility triggers fear rather than curiosity, traders exit too early or hold losing positions too long. Herding behavior amplifies moves beyond fundamentals. During times of geopolitical stress, herding behavior increases. Studies show that high geopolitical risk can reduce the ability to process information and lead to imitation-based market actions rather than independent analysis, which intensifies moves. What starts as a sensible risk-off shift can snowball into a broader panic response. Quiet periods of discounting geopolitical risk give way to loud swings when fear peaks. From a psychology standpoint, this highlights a crucial truth. Markets don't just move because of events, they move because of how we collectively react to those events. Emotional contagion across trading floors and screens can decouple price from fundamentals temporarily. Clarity over chaos. This mindset moderates market impact. Despite headlines and short-term noise, historical evidence shows that geopolitical shocks often cause temporary repricing, not permanent destruction of value. Over longer periods, once uncertainty becomes known risk, markets adapt. But the psychological journey between shock and adaptation is where most traders lose money because they trade headlines instead of structure. Developing emotional regulation, not just technical skills, separate those who survive from those who don't. Traders who anchor decisions in predefined strategy instead of reactive fear are better positioned when markets shift from panic to evaluation. When the world feels unstable, it's completely natural for your mind to feel unstable too. War headlines, economic uncertainty, and constant breaking news create a sense that the ground beneath us is shifting. Your brain is wired to protect you from danger. And when conflict appears on the global stage, your nervous system interprets it as a signal that something important and possibly threatening is happening. So if you find yourself feeling uneasy while watching the markets during times like this, understand that your reaction is not weakness, it's awareness. Financial markets are deeply connected to human emotion. And during times of geopolitical tension, those emotions amplify. Traders around the world begin asking the same question. What happens next? Will oil spike? Will the market crash? Should I get out or double down? These questions can make even experienced investors feel uncertain. The truth is that when the world feels chaotic, the markets often reflect that chaos, and recognizing that emotional turbulence is the first step toward navigating it wisely. Fear, in many ways, is a signal that something meaningful is happening. It tells us to slow down, observe carefully, and avoid reckless decisions. But during times of war and geopolitical tension, fear reminds traders that the environment has changed as well. Markets may move faster, volatility may increase, and the old assumptions may no longer apply. That fear isn't your enemy. It's a reminder that discipline and clarity matter more than ever. Uncertainty can also create the feeling that you are somehow behind or missing something that everyone else understands. Social media, news channels, and financial commentary can make it seem like others have perfect clarity while you're still trying to make sense of the situation. But the truth is that uncertainty is universal. Even the largest institutions in the world are trying to interpret the same signals. Acknowledging that shared uncertainty can actually free you from the pressure of believing you must have all the answers immediately. During chaotic times, our instincts often push us toward action. We want to do something, enter a trade, exit a position, react to the news. But the most powerful traders in the world understand something important. Chaos rewards patience. When emotions are running high, the edge belongs to those who slow down, analyze the environment, and allow structure to guide their decisions rather than letting fear dictate them. This is why trading psychology becomes so important when the world feels uncertain. The difference between panic and discipline is not intelligence, it's preparation. Traders who have rules, levels, and a clear framework are able to navigate volatility with far more confidence. Instead of reacting to every headline, they rely on structure to tell them when to act and when to wait. Moments like these also remind us that markets are not just numbers on a screen, they're reflections of human behavior. War, uncertainty, fear, and hope all show up in price movement. Understanding that emotional energy helps traders step back and recognize that volatility is not just chaos, it's information. And those who learn to read that information calmly can transform uncertainty into opportunity. If the noise in the markets is starting to feel overwhelming, you don't have to navigate it alone. One way to bring clarity back into your trading is by focusing on structure rather than headlines. That's why we share the exact SPY levels we're watching every day inside our free community to help traders stay disciplined when the market gets chaotic. If this message resonated with you, comment below, like the video, and subscribe. And check the link in the description and the comment section to join the group and start receiving the daily SPY levels so you can trade with structure instead of confusion. You've got this. Peace and blessings, Dr. O.